Welcome to this JSAIM training on eMoney Advisor. Today we're here to help you better understand the cash flow report, how to read it, understand where the information feeding it comes from, and how to input possible goals or scenarios that you want to investigate. To begin, this training does assume that you have already linked all of your accounts so that you have a pretty comprehensive idea of your net worth and what it is that you have to work with that you're already working with. If you do not have all those things linked and are having troubles with that, please make sure you contact whoever's up here in this top left-hand corner or send an email to support@jsaim.com and we will get in contact with you and help you out. Before we dive into where the information in the cash flow report comes from, let's make sure we understand what the cash flow report is, and you'll be able to see the different manipulations of it. When you come to the reports, here in this drop-down menu is all the different reports you can take a look at. We are going to just look at the overall cash flow. Here we've got Frank and Joanna Miller, our sample client. They've got all their information in, and we can see that according to their goal, they want to have money planned out by the time that they're 90, and so they meet their goal. They're getting a little slim, but they're going to meet their goal. Down below you can see what is being demonstrated here visually. We've got income flows, we've got the total inflows, the total outflows, planned savings. You'll see where this comes from as well, and then the total portfolio assets, the growth that we're assuming. You'll also see up here we've got inflation as a part of this report. That helps with the growth. Assumed inflation in our case is 3.76%, which is a little higher than the 100-year average by about 0.5%. So you'll see here there is a living expenses are tied to the cash flow report. That's what we're going to show you here today, and how to manipulate some of those living expenses based on the goals or purchases that you want to investigate. In order to get this information in here, you have to come to the organizer. And when you come to the organizer, first make sure that you've got your income and your expenses set. So here we've got Frank's salary and bonuses and Joanna's part-time work. We just put in a number for annual living expenses. Depending on how detailed you've gotten into eMoney, and you can estimate that living expense from your budgeting tool, or you can add itemized if you already know. Great. But you'll see here this is their income. We've just put a simple 401k contribution with a match in here by way of savings. You can add more to that, connecting it to your specific accounts. And then you have to come to accounts so that you can see the current assets, mortgages, credit cards, liabilities, things like that. And all this comes together to form the comprehensive cash flow report. Now what we're going to investigate today is Frank and Joanna's desire to buy a small vacation bungalow in a warmer area than in which they live. So we're going to come here in accounts and we are going to add a liability. We're going to add a mortgage. They want to see if they've been saving for it. We're going to label it possible vacation home. They want to see if the purchase of this little home by next year, 2018, will be okay for them to pay into retirement. So they're looking for a vacation property. It's going to be a mortgage. The interest rate they're hoping is still going to be 4%. You can manipulate the interest rates. You can manipulate the term of the loan. They're looking at 30 years, seeing how that's going to impact them into retirement. The original loan amount, they bought the home for $150,000. They put down 10 grand, so they've got 140,000 left on the loan, and that's going to be as of, they want to buy it by May 1st, 2018. The current balance and the date of loan would be the same thing. They're going to have the 30-year loan, pay on it monthly, type of principal and interest about $1,000 a month, and that will be deductible. So we've got all this information in here. We click save. After we've put that information in, we go back to the cash flow report and we take a look at how it is impacted our overall cash flow into retirement. And you can see there's a steep decrease. If based on their current spending and saving practices, if Frank and Joanna Miller buy this home, they will run out of money, most likely around the time they're 80 in retirement, leaving about 10 years left that they were hoping to have covered just in case. The great thing about this is now they understand I need to make some adjustments. Either we not buy the home, or are there things we could do to facilitate the purchase of the home? Do we need to adjust our savings, our 401k contributions? Do we need to spend a little less now? One thing we're going to take a look at, just so you can kind of see how this works, is we're going to go back to the organizer. They didn't want to rent out a property. That seems like a little bit of a hassle to them, but they really, really want this vacation home. And so they're going to take a look at, well, what will happen if we rent it out just on the weekends? And we want to make sure we've got 20 weekends available. We're going to rent it out 30 weekends, and we are going to add an other source of income. They're thinking about renting this out. Let's see, we're going to call it rental property. They're thinking about renting this out for $250 a night, 30 weekends out of the year. They want it free during the week, minimal management. And so they want it to start in 2018 and end in retirement, so they can have total access to it. So based on that idea of $250 a night and 30 weekends, we're going to have $15,000 of income in the year. So let's add that. We can see right here, rental property income. And we go back to the reports. By adding that little bit of income, let's see what happens. We see that it's actually a pretty good idea if they were able to do that. Their retirement money would last. They'd actually have a little bit more to leave onto their kids if that was an important thing for them to do. Just by renting it out 2/3 of the year, they could have sufficient funding to have their vacation home and have enough money in retirement and meet their desired goal. So that's how that works. If you have any further questions, again, please contact us at support@jsa.com and have fun planning.